Welcome to Sheen Research, your strategic partner in comprehensive investment analysis. We're turning our attention today to Americold Realty Trust, ticker COLD. And this is it's a fascinating and, frankly, a highly contentious stock right now.
It really is.
Sitting right at this intersection of real estate, logistics, and, the entire global food supply chain. For you, we've gone through a whole stack of sources earnings, transcripts, analyst reports, market commentary to really try and figure out why the market can't seem to agree on this one.
It can't.
Is the company deeply undervalued or is it, fundamentally flawed?
And that tension is exactly why this company demands a closer look. Cold is, by definition, the global leader in temperature-controlled storage and logistics.
Right.
They manage a truly enormous network. We're talking 235 warehouses, which totals approximately 1.4 billion cubic feet of space.
Globally?
As of September 30, 2025.
1.4 billion.
It is, without any exaggeration, mission-critical infrastructure for the global cold chain.
But despite that vital role, the stock has just been hammered.
Yeah. Oh, completely.
We're looking at some really extreme volatility. The price has plummeted, roughly 42% year-to-date as of early October?
Yeah, that's right.
It is trading at its lowest price point since its IPO back in 2018. This kind of collapse, it forces you to ask some tough questions.
Precisely. And the analyst community is just split right down the middle. Yep. You have the bearish camp, initiating coverage with the sell rating. And they're arguing that the company is structurally misunderstood.
Okay.
Then you have the bullish side. They're saying outperform or overweight, and they're essentially calling the current price a cool bargain.
A cool bargain.
Yeah. Our mission today is to cut through that noise, investigate the Q3 2025 earnings results, and really synthesize these contrasting views on its fundamental business model.
Is Americold primarily an industrial REIT, a stable landlord, or is it something else? Is it a specialized cyclical services provider completely dependent on fluctuating food volume?
That's the billion-dollar question.
Before we tackle that whole identity crisis, we absolutely have to ground this discussion in the mandatory numerical facts. We're looking at the third quarter of 2025, and the headlines, they show stress, but also some counterintuitive strength, which is, kind of typical for a large company going through a difficult transition.
It is. So it started with the top line. Revenues showed some mild resilience. It actually beat consensus estimates.
Okay.
Total revenues for Q3 2025 came in at approximately $663.7 million.
So $663.7 million.
Now, this was a slight dip compared to Q3 2024, which was about $674.2 million. So that's a 1.56% year-over-year decrease.
Right.
But crucially, the internal transcript summary noted that this figure surpassed analyst expectations by about $5.16 million.
So a small win on revenue, it suggests maybe pricing power or some successful cost pass-throughs helped offset some of those volume losses we've been hearing about.
Exactly.
But when we look at the bottom line, the picture darkens significantly.
It does. The company posted a net loss in Q3 2025 of negative $11.4 million.
$11.4 million in the red.
And this is almost 3 times wider than the net loss from Q3 2024, which was negative $3.7 million.
Wow. That results in a net loss per common share of negative 4 cents.
Yeah. That divergence between, some stability in revenue and a worsening net loss, that's a red flag.
For sure.
However, we have to remember, for a REIT, net loss is a GAAP metric. It's heavily influenced by non-cash charges. Things like depreciation and amortization.
Right, which is why we always pivot to the REIT-specific metrics.
We have to.
So let's talk about funds from operations, or FFO. It's generally considered the superior gauge of a REIT's operating cash flow because it strips out that non-cash depreciation related to the real estate itself.
And here, the news was a bit mixed. Adjusted FFO per share for Q3 2025 was $0.35.
35 cents.
But that, unfortunately, missed analyst estimates by 2 cents.
Okay, so a slight miss there. And what about the statutory measure, the NAREIT FFO?
Looking at it, it was $43.15 million in Q3 2025. And that's a decline from $55.54 million in the same quarter last year.
So the quarter was tough pretty much across the board on the key profitability metrics.
It was.
Now, let's zoom out quickly to the 9-month period. That usually helps contextualize some of these quarterly movements.
Yeah, idea.
Total revenues for the first 9 months of 2025 were $1.94 billion, down just slightly from $2.0 billion in the same period for 2024.
Okay, pretty flat.
But here's a really interesting counterpoint to that quarterly trend. The 9-month net loss actually showed massive improvement.
No.
It shrank from a loss of $58.3 million in the first 9 months of 2024 to a loss of just $26.4 million in 2025.
Okay, that huge swing needs some context, though.
Right.
Because it doesn't really reflect improved operations as much as it reflects a non-recurring event in the prior year.
What happened?
Back in the first 9 months of 2024, the company recorded a massive $116 million loss on debt extinguishment and termination of some derivative instrument.
Okay, that's a big number.
It's a very complex event. It was tied to the company buying back facilities that had been part of a prior failed sale-leaseback arrangement. If you exclude that noise, the 9-month 2025 operating income would actually be weaker year over year.
Which brings us right back to FFO.
It does. The core cash flow metric, NAREIT FFO, for the first 9 months of 2025 was $131.6 million.
Okay.
And that's substantially up from $110.8 million in the first 9 months of 2024.
So that shows that despite all the operational headwinds, the underlying cash flow generation, when you measure it properly for a REIT, it's actually holding up relatively better than that quarterly net loss would suggest.
Right. It gives the bulls something to hang their hat on.
Some confidence, maybe.
Confidence, perhaps, but the debt structure remains a major target for the bears. We need to talk about leverage.
Okay, let's get into it.
As of the quarter end, Coldy reported net debt to pro forma core EBITDA at 6.7x.
6.7 times.
We saw similar critiques citing a 6.3x ratio earlier in the year. Either way you slice it, this number is high for a company, especially one facing genuine cyclical headwinds and, falling occupancy.
6.7 times EBITDA is definitely high. But for the listener, let's contextualize this a bit. I mean, industrial REITs that specialize in dry storage, they often aim for leverage closer to 5.0x, maybe even less.
Much less, yeah.
So if Americold were generating stable, fixed, 95% plus occupancy revenues like a standard REIT, maybe 6.7x is manageable. But given that 40% of their business is in that highly competitive 4 distribution node and occupancy is falling, does that 6.7x ratio become an existential threat? What are analysts saying about the risk to their debt covenants?
That's the core question. The risk is amplified because the market views their EBITDA as less stable than a standard REIT's.
Right, it's more volatile.
Exactly. So if that EBITDA drops substantially next year, that leverage ratio will climb really fast.
Yeah.
It could potentially push them close to their covenant limits, though, management insists they have ample cushion. The sheer quantum of debt is significant, though, regardless of the ratio. Barron's noted they carry $3.9 billion in net debt. The 10Q confirms it. Total principal amount of indebtedness reached $3.92 billion as of September 30th.
And that's up from what it was at the end of 2024.
It is. A noticeable increase from $3.3 billion at the end of last year.
So they are actively adding to the balance sheet. How are they managing this debt load, especially with, rising interest rates?
Well, they've been proactive in refinancing and trying to optimize their maturity schedule. They completed an underwritten public offering of $400.0 million in senior unsecured notes due May 15th, 2032.
Okay, so that's about 8-year debt. What's the rate on that?
It carries a 5.6% interest rate. And the proceeds were used to repay existing borrowings, so they were essentially extending their maturity and locking in a rate.
But even managing the debt, that comes with a cost.
Absolutely. They incurred approximately $4.2 million in debt issuance costs and a $2.6 million discount related to that offering. They also successfully hedged $300 million of that offering through Treasury lock transactions, which did provide them with a small gain of $1.3 million. So they are sophisticated in their debt management, but the overall debt load is undeniably heavy.
Okay, so despite that high net debt, their reported liquidity position still remains relatively strong. They have about $800 million of available liquidity at quarter end. That provides a buffer against any immediate shocks.
It does.
Now, let's pivot quickly to shareholder returns. For a lot of investors, this stock is purely a yield play.
It is compelling on paper. Barron's noted a dividend yield as high as 7.4% as of early October. A slightly adjusted figure of 6.7% came from a later seeking alpha analysis.
Okay, and the key metric for assessing the safety of that dividend is the payout ratio. Where does that stand?
It's currently reported to be around 65% of adjusted FFO.
65% AFO payout. I mean, that suggests the dividend is safe, assuming cash flows don't deteriorate significantly further.
Right, but this is exactly where the bearish critique hits the hardest.
Because if the pricing and occupancy pressures that management is anticipating for 2026 actually materialize,
that safety buffer shrinks, and it shrinks fast.
Yeah.
And that makes a dividend very vulnerable. It creates a very high-stakes scenario. The operational stability of that dividend is entirely dependent on the segments we're about to discuss.
All right, so let's drill down into the operating performance of the warehouse segment. This is the heart of Americold's business. This is where we see that battle between pricing power and volume loss really play out.
Okay, starting with the overall segment performance in Q3, on a constant currency basis, total revenues for the warehouse segment decreased by 0.8%,
Okay, less than 1%.
which translates to about a $4.8 million reduction year over year. Now, the cost of operations, they managed to decrease that as well, but only by 0.3%, or $1.4 million.
So costs didn't shrink as fast as revenue.
Exactly, which means the contribution net operating income, or NOI, for the segment decreased by 1.7%.
And the major operational drag here is clearly occupancy.
It is. Economic occupancy for Q3 dropped to 73.8%. That's down 290 basis points year over year.
Nearly 3 percentage points.
And physical occupancy, so the actual product sitting in the racks, it fell even further to 62.8%. That's down 380 basis points.
Let's pause on that. 62.8% physical occupancy. I mean, that is perhaps the single strongest piece of evidence supporting that cyclical services argument over the stable REIT argument.
I agree completely.
Traditional industrial REITs, they're often striving for physical occupancy in the mid to high 90s. When occupancy falls this low, it signifies a massive volume decline driven by macro factors. Customers are intentionally holding less inventory, and there's increased competition.
Right. And the 9-month view confirms this structural pressure. Same-store economic occupancy decreased 370 basis points year over year. We're looking at 75.9% versus 79.6% in the first 9 months of 2024.
So the decline is widespread, not just isolated to a few troubled facilities.
But here's the massive counter-narrative, the surprise twist. Pricing power remains remarkably strong. Despite the volume drop, rent and storage revenue per average economic occupied pallet actually increased. It went to $64.37 in Q3.
And what's that as an increase?
That's a 3.9% actual increase year over year.
That is critical. So management is clearly prioritizing price stability and rate increases, even if it means sacrificing some volume or some economic occupancy. They're successfully extracting higher rates from the customers they do retain.
And this pricing stability is protected by their contract structure. Fixed commitment contracts. This is where customers reserve and pay for space whether they use it or not, kind of mimicking a traditional real estate lease.
Right.
Those held steady at 60% of rent and storage revenue. This is a record high for the company, and it maintains their long-term goal. With 70% of their revenue coming from their top 100 customers, these sticky fixed commitments are the backbone of their REIT foundation defense.
Okay, now we shift to the services side. This is the operational part of the business that generates handling margins, the logistics fees for moving pallets. This is where that services provider narrative gains steam.
Throughput pallets, so the actual volume of product moving through their facilities, that dropped 3.4% year over year in Q3. It totaled about 8.89 million pallets.
And again, pricing helped mitigate this volume loss.
It did. Warehouse services revenue per throughput pallet increased to $38.91. That's a 2.4% actual increase year over year. And management highlighted a key operational win here. Handling margins are on track to exceed 12%, which is outpacing their historical levels.
How are they achieving those margin improvements despite lower volume? It speaks to some genuine cost control and efficiency.
It's driven by matching direct labor costs precisely to throughput volume. They've successfully deployed strategies, some of which are enabled by Project Orion, which we'll get to later, that allow them to flex their labor pool immediately when customer throughput drops.
So they turn a volume decrease into a margin win.
That's how they do it.
And beyond just labor efficiency, they're actively pruning the portfolio.
They are. They're conducting robust reviews of low occupancy sites, especially the ones that are leased rather than owned. They successfully exited 3 of those sites in Q3, with 3 more targeted for the near term. They're typically consolidating that inventory into nearby owned locations.
It sounds painful, but probably necessary portfolio right-sizing.
It is. Now, outside of that core warehouse business, the smaller segments are also feeling the macro pinch. The transportation segment, which handles movement between facilities, saw revenues decrease 7.7% on a constant currency basis in Q3. That's a $4.0 million decrease.
And what drove it?
Just lower volumes generally,
Mm-hmm.
softening transportation demand across the entire logistics sector, plus some specific customer and site exits in North America and Europe.
Okay.
The margin for this segment held up reasonably well, though. It contracted only slightly by 10 basis points to 16.2%, which suggests they aren't engaging in, aggressive price wars just to maintain volume.
And the third-party managed segment, that's on even steeper revenue decline, a 12.3% drop on a constant currency basis. This is the segment where they're managing facilities owned by their customers.
Right, and that decrease was primarily due to the purposeful cessation of operations at certain client sites. There was a major one that closed in Q1 of 2025.
I see.
The positive side of this contraction is that management aggressively cut the costs associated with those sites. The cost of operations decreased 18.1%, which is significantly faster than the revenue decline.
Which means the margin actually expanded dramatically.
Exactly. The margin for the third-party managed segment soared to 26.2%. That's an increase of 510 basis points.
Wow.
This demonstrates that when they decide to pull back from a site or a contract, they execute a highly efficient exit strategy that minimizes cost drag and boosts those margin percentages, even if the top-line revenue shrinks.
So this operational performance, showing stable pricing but volatile occupancy and volume, it brings us to the core identity crisis for Americold. Is it a landlord that just happens to offer services, or is it a highly leveraged logistics provider that just happens to own its buildings?
Management under CEO Rob Chambers is adamant that the foundation is a REIT. They constantly reiterate that over 80% of their assets are owned, and they leverage these mission-critical facilities to secure stable cash flows, primarily through those fixed commitment contracts we just talked about.
So for them, the services are just value add, leveraging the owned real estate, not the primary focus.
That's the argument. And to defend this REIT foundation, Chambers has framed their strategy around 4 key cold chain nodes. This diversification is key to understanding why not all of Americold's business faces the same competitive threat.
Let's spend some time on this, because it feels like the most critical strategic insight for any investor. These 4 nodes, they define the moats and I guess the vulnerabilities.
They do. So, starting with node 1, production-advantaged or production-attached facilities. These assets make up about 30% of their capacity and revenue.
And explain why these are so valuable.
Well, these are highly specialized assets. They're often built directly next to a food manufacturer's processing plant, think dedicated storage, that's adjacent to a massive poultry facility in, say, Russellville, Arkansas.
So the analogy here isn't a parking garage. It's more like a dedicated pipeline.
Precisely. They are infrastructure, not speculative storage. Management noted that these facilities show the highest gap between physical and economic occupancy.
Meaning the customers reserve the space whether they fill it or not.
Right. The customer pays for the reservation, making these revenues highly REIT-like and highly immune from speculative capacity building by competitors. So you can't just easily replicate that proximity and that level of integration.
Okay, so that's node 1. Node 2, the 4 distribution centers. This is the largest segment and also the biggest pain point. It accounts for 50% of capacity and 40% of revenue. These are multi-tenanted public facilities located near major population centers.
This is the commodity cold storage business.
Right.
And it is under massive pressure. Management estimates that over the last 4 years, North America has seen roughly 3 million new pallet positions added.
3 million.
Which is over 15% incremental capacity. And most of it is focused right here.
So that speculative building glut is creating a terrible environment for Americold in this specific node.
It creates a buyer's market. It tries high pressure on renewal levels and on rates. If a new, shiny, state-of-the-art competitor box opens up 5 miles away, multi-tenanted customers have very low switching costs. They can easily move their volume.
This is the cyclical services segment masquerading as real estate, and it's why the stock has been punished.
It really is. Now, moving to node 3, you have the retail distribution centers. This currently represents 10% of capacity, but a disproportionately high 20% of revenue.
So more revenue per square foot. This is a key growth area for management.
This is where their operational expertise is monetized heavily. It's not just storing frozen peas. It involves highly complex, operationally intensive tasks. Things like case picking, building multi-SKU custom pallets tailored to specific retail store delivery routes, managing just-in-time inventory.
So a lot more hands-on work.
Exactly. And that work commands a much higher NOI per pallet position than standard storage.
And why is this such a good opportunity?
Because today, most major retailers do this kind of operationally intensive work in-house. It's insourced. Americold believes they can convince these retailers to outsource the complex cold chain management to them, capitalizing on their skill and their technology. Their acquisition of that Houston warehouse for $108.4 million earlier this year was specifically targeted to service a new fixed commitment retail contract. It validates this growth strategy. Competitors that only offer basic storage, they really struggle to deliver this level of customized high-touch service.
Okay. And finally, node 4, port facilities. That accounts for 10% of both capacity and revenue.
Right. These are multi-tenanted facilities, but they have limited fixed commitments because the product moves so quickly. These are import-export hubs. This area has also seen some speculative development in key ports like Jacksonville, Charleston, and Savannah.
So what's Americold's defense here?
They're focusing on strategic partnerships. They cited the development at Port St. John in Canada, which was done with CPKC, the railroad, and DP World, the marine terminal operator.
Okay, so integrating with other parts of the supply chain.
Exactly. And the import-export hub at the port of Jebel Ali in Dubai, also with DP World. These partnerships create unique, integrated supply chain solutions that a new entrant just focused on building a box near the dock, they can't replicate that. This complexity is their moat.
So management's defense rests on the diversity of these nodes and the stability of the production and retail segments. But let's look at the analyst critique. The bears are arguing that this portfolio is dominated by operational risk, regardless of who holds the title deed.
The bearish argument is pretty straightforward. Americold operates primarily as a logistics and processing services provider, using the real estate as a necessary component, not as the primary revenue driver.
Right.
They point out that even Amazon owning its warehouses doesn't make it a logistics REIT. It's still a retail services and tech company.
And the evidence they cite is compelling, those falling occupancy rates. That sustained decline in physical occupancy to 62.8%. It just screams cyclical, highly pressured business. Traditional real estate simply does not experience that level of vacancy unless a major tenant goes bankrupt.
Exactly. Furthermore, you have to consider the development yields. Americold aims for these outsized development returns that are well above the mid-single-digit cash yields typical of industrial REIT peers.
So they're targeting high operational returns on capital.
Which introduces a different, higher risk profile than a purely passive landlord.
And the high leverage of 6.7x just amplifies all those cyclical risks, making the whole operation seem fragile if the cycle turns negative. If customers in that 4 distribution node can easily switch to a competitor offering better pricing or capacity, the lack of switching costs makes the entire business vulnerable to pricing wars.
That's the essence of the debate. The bulls see the high returns in production and retail as defensible moats. The bears see the high development yields in the commodity segments as a giant target for competitors. It's that your margin is my opportunity philosophy. They argue that management's focus on high operational returns is just incompatible with the low-risk, stable profile necessary to justify a high REIT valuation multiple.
This all hinges on whether the current headwinds are, as management claims, merely transitory.
Exactly.
So given the intense scrutiny on profitability and margins, management has been forced to focus intensely on execution. CEO Rob Chambers laid out some core priorities that are all focused on operational efficiency rather than purely real estate management.
That operational focus includes things like improving customer service, workforce retention and productivity, growing those service margins, and maintaining their development pipeline.
These aren't typical REIT priorities.
No, they're logistics business priorities.
So what specific initiatives are translating into those margin improvements? We saw the handling margins improve despite the volume drops.
They're centralizing processes, implementing standard operating procedures globally, adopting new technology, and leveraging their purchasing power. On the facility cost side, which is enormous for a cold storage provider, they are making targeted capital investments in energy efficiency.
Energy is crucial. I mean, running a freezer warehouse is exponentially more expensive than running a dry warehouse.
It is. So they're investing in LED lighting, advanced thermal and solar energy storage, motion sensors, rapid open-close doors, basically anything to keep the cold in and the energy bill down. They actively participate in power demand response programs. And they noted that their cost structure is stable because they have these efficiency projects and the contractual ability to pass on cost increases in many markets.
So that minimizes the risk of energy inflation eating into their margins.
It does.
Now, the foundation for a lot of this operational shift is the massive company-wide technology overhaul, Project Orion. This transformation program is designed to drive future growth and strategic objectives through a new cloud-based ERP system.
This is a staggering expense, but it represents management's commitment to shifting the business away from a sort of decentralized operation toward a globally integrated system.
And the strategic benefit isn't just new software.
No. It's about centralizing data, improving operational visibility, and eventually enabling AI-driven demand forecasting and labor management. They are basically buying operational intelligence.
And the cost. Since inception, $212.5 million has been incurred in implementation costs for Project Orion. That's a huge outlay for a company with an $8 billion enterprise value.
It is a huge outlay. As of September 30th, the unamortized balance of deferred costs stood at $82.9 million. These costs related to Phase 1 implementation, which involved North America and Asia Pacific and deployed in Q2 of 2024, they're being amortized over 10 years.
So that amortization expense will be hitting the income statement for years to come.
It already is, and it's increasing sharply. The amortization expense recognized in Q3 2025 was $6.1 million. That's a substantial jump from $1.8 million in Q3 of 2024.
And that increase directly contributes to that widening net loss we talked about earlier, even though it's a non-cash charge.
It does. Now, on the non-capitalizable side, so the direct expenses for consultants and internal teams, Project Orion expenses for Q3 were $11.89 million. But this actually showed an improvement year over year. Yeah. They saw a decrease of $9.7 million year over year in those non-capitalizable costs. That's primarily due to the wind down of contract labor and professional fees as the project moves past its initial intensive build phase.
Okay, so that suggests the worst of the cash strain from the implementation is now behind them, even though the amortization schedule is just ramping up.
That seems to be the case.
So beyond technology, management is aggressively managing its asset base, pruning weaker properties, and acquiring strategically important ones, particularly within that high-margin retail node.
The Houston acquisition in March of 2025 is the perfect example. They spent $108.4 million in cash, specifically to optimize customer product transfer and to secure a new fixed commitment retail contract. They recorded $38.5 million in goodwill, which is essentially the premium they paid for securing that long-term high-margin retail relationship and operational advantage.
And on the disposition side, they're shedding non-core assets globally.
They are. They sold their 14.99% equity interest in the Superfrio joint venture for $27.5 million, recognizing a net gain of $2.4 million. They're also selling off older facilities. During the 9 months ending September 30th, they finalized the sale of 4 facilities for $24.4 million in total proceeds, and they recognized an $11.6 million gain. This active management is all aimed at maximizing capital efficiency and focusing on their core high-performing nodes.
But this process of right-sizing, it comes with a steep price tag in the short term. We saw a massive jump in closed site costs.
A phenomenal jump. Closed site costs incurred for the first 9 months of 2025 totaled $15.85 million.
Okay, and what was it last year?
Compare that to just $1.68 million in the first 9 months of 2024.
Wow, that's a tenfold increase in closed site costs. That's a painful price tag for right-sizing the portfolio. Is management being too aggressive, or is this just necessary pain?
It's necessary pain, unfortunately. This figure is driven by significant expenses like $5 zillion in lease termination fees and other expenses related to those recently exited operations. This is the cost of moving inventory, shutting down refrigeration systems, and breaking contracts to exit the least profitable sites. If these sites were dragging down that average 62% physical occupancy figure, then spending $15 million now to stabilize margins for the future is likely a prudent, albeit painful, decision.
So we have an aggressively managed company executing a massive technological overhaul, simultaneously right-sizing its physical footprint, and all of this is set against a deeply challenging market backdrop.
Yep.
Let's look at the headwinds they identified in the Q&A session on the earnings call.
Okay, the headwinds are coming from 2 sides: constrained demand and excess supply. On the demand side, management commentary pointed to broad economic pressure on the consumer.
Right.
Lower and middle-income consumers are pressured by food inflation, elevated interest rates, tariff uncertainty, and reductions in governmental benefits.
And the outcome of that consumer pressure is constrained inventory demand.
Exactly. Customers are hesitant to build inventory until they see a sustained increase in consumer spending and demand. They are running leaner, tighter supply chains, which translates directly to lower physical occupancy in Americold's warehouses.
And on the supply side, the fundamental problem remains that glut of speculative capacity, particularly in that competitive for-distribution node. The industry overbuilt, and now they're paying the price.
They are. And this is where we pause on a fascinating, if speculative, long-term risk management brought up. the potential impact of GLP-1 diet drugs,
Like Ozempic.
like Ozempic, on the frozen food industry.
This is a classic example of a behavioral trend introducing risk to core infrastructure investing. How exactly does a diabetes or weight loss drug depress the stock of a cold storage REIT?
Well, it's about the long tail risk. These drugs are fundamentally changing consumer behavior around food consumption. If sustained use leads to a secular decline in overall food volume, particularly high-calorie processed or frozen foods, it could suppress long-term demand for cold storage. Management mentioned this as a factor depressing the stock because it introduces uncertainty about the long-term growth trajectory of the entire cold chain. It forces some investors to put a lower multiple on all infrastructure in the sector. It's like a qualitative risk, but one that the markets are certainly mulling over.
And even with all these headwinds, management noted that new business wins in their sales pipeline are expected to hit a record this year.
They are winning contracts, but the realization of those wins is slower than they planned.
Ah.
Furthermore, the volumes often come in lower than contracted, so this means the new business being won is primarily just offsetting reductions in the base business and traditional customer churn rather than driving net growth.
It's a treadmill scenario.
It is.
And all these factors led management to reaffirm their guidance framework for the rest of 2025. But they provided a deeply sobering quantitative outlook for 2026. This is where investors really need to pay maximum attention.
The biggest takeaway is that the operational gains they've enjoyed, those pricing increases, are expected to moderate significantly next year. They anticipate a pricing headwind of 100 to 200 basis points across storage and services in 2026.
From 1 to 2%.
And this is almost entirely due to that competitive pressure in the 4 distribution node.
And the occupancy problem isn't expected to magically fix itself either.
Unfortunately not. Management anticipates a further decrease in economic occupancy next year, a drop of approximately 200 to 300 basis points, as customers continue their aggressive space commitment reduction to manage those tight inventory levels.
200 to 300 basis points on occupancy, plus 100 to 200 basis points of pricing pressure. Those are material headwinds.
They are. And while management insists these headwinds are largely transitory, they are simultaneously forecasting that the excess capacity in the industry will likely take a couple of years to be fully absorbed. They did note one positive sign. New development announcements are already slowing down, which suggests the supply-side pressure might eventually peak. But the pain is definitely extending into 2026.
Which brings us directly back to the valuation debate. Investors have to decide whether the transitory pain is worth enduring for the long-term value of these assets.
Right. And the bull case, which is supported by sources like Barron's, focuses on the current incredibly low valuation. The stock trades for under 10 times estimated 2025 adjusted FFO.
Under 10x.
Now compare that to the industrial REIT average, which often trades at multiples of over 20 times FFO. That's a massive valuation gap.
They're arguing the stock is trading at a deep discount to its replacement cost and private market values. Let's explore that replacement cost argument for a minute. Why is cold storage replacement costs so high?
Well, standard dry industrial logistics space might cost, say, $150 per square foot to build. Cold storage, it's exponentially higher. You have extreme structural requirements for insulation, vapor barriers, super flat floors to handle tall racking systems, and most importantly, the massive multi-million-dollar ammonia refrigeration systems required to maintain temperatures down to negative 20 degrees Fahrenheit.
So the complexity and the specialized equipment mean the cost to build a modern cold storage facility is far higher than the current stock price implies.
It is, and management echoes this intrinsic value argument. The CEO noted that their current enterprise value of roughly $8 billion is well below the replacement cost for their 5.5 million pallet positions, plus the value of their operating system, Project Orion, and their operational knowledge base. Furthermore, the stock is trading at a historically high implied cap rate of around 10%.
10.
For mission-critical infrastructure that's backed by long-term agreements, a 10% cap rate is wildly unusual. It suggests the market is pricing in extremely high risk or an imminent dividend cut. For the bulls, that is the ultimate buying signal.
And the small market capitalization of Americold, currently around $3.5 billion, makes it appealing for potential acquirer, especially when you compare it to private peers like Lineage, which is valued closer to $9.2 billion. The long-term fundamentals, the need for cold chain logistics as global meat and fresh food consumption rises, are still positive.
Now, the bear case, detailed by Seeking Alpha, hinges entirely on cyclicality and risk. The high 6.7% dividend yield is simply insufficient compensation for the high leverage and the cyclical nature of the service business. They warn explicitly that a dividend cut is a real possibility if the anticipated declines continue through 2026.
Which would wipe out the primary reason many investors hold the stock.
Exactly. They also argue management is misallocating capital. Given the significant discount to intrinsic value, the bears suggest management should prioritize stock repurchases, which would be immediately accretive, instead of pouring capital into new development projects that, in this environment, have yet to hit stabilized, attractive yields.
It's a valid point. If you truly believe your stock is undervalued by 50%, buying back shares is often the best possible return on capital. It's better than any development project.
It is. And the choice management makes between development and buybacks will signal their true confidence level in their own valuation.
So it's clear the core conflict landlord versus logistics provider, it remains unresolved. The bulls are focused on the long-term, expensive physical assets, while the bears are trading on the immediate and quantifiable operational headwinds.
And we must reiterate the value of differentiation here. The production advantaged and the retail facilities are genuinely strong, differentiated growth opportunities. These are the defensive elements that contrast sharply with that highly competitive Ford distribution node, which is acting as the primary drag on overall performance.
Right.
And these defensive nodes, they provide the stability needed to weather the storm.
So the overriding qualitative summary here is that cold storage is absolutely fundamental to the global food supply chain. I mean, despite the immediate struggles and the identity crisis over Americold's true operational nature, the company owns and operates essential infrastructure. If the macro environment improves and those constrained inventory levels normalize, the company is fundamentally positioned well to capitalize on the massive internal investments it has made: Project Orion, portfolio pruning, operational excellence.
The question for the investor is one of timing and patience. Are they willing to wait the couple of years management specified for the excess capacity to be absorbed, enduring the anticipated 100-200 basis point pricing headwind and the 200-300 basis point occupancy decline expected in 2026? Or does the 6.7x leverage necessitate a more cautious approach until stabilization is clearly visible?
I think the strategic focus on those complex, high-margin, differentiated areas, like the strategic port partnerships with DP World, or leaning into the operationally complex retail sector, that will be the key indicator of whether Americold can successfully defend and grow its market share throughout this volatile cycle and ultimately prove that bull case correct.
The immediate catalyst we will be watching is whether management chooses to implement a stock repurchase program that would validate their claim of being significantly undervalued and signal a powerful level of internal conviction to the market.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.